Hi, I'm Lena, and welcome to Super Data JP, the channel where we turn Japan's real estate and cost of living numbers into answers you can actually use. Every video here is built on verified government data, not opinions and not guesses. Whether you're planning to invest, relocate, or just curious what life in Japan really costs, you're in the right place. Let's get into today's numbers.
Fire insurance shows up as a line item you sign off on. This policy doesn't. It's baked directly into your mortgage interest rate, and most homeowners never realize they're paying for it at all, let alone how much it can quietly grow to. Second and final video in the insurance series for foreign residents in Japan. Last time, fire insurance. This time, the life insurance requirement hiding inside every home loan. Same structure as fire insurance, on paper, legally mandatory is false. No law forces a borrower to carry mortgage life insurance, none at all. In practice, private mortgage lenders make it a condition of approval. This is Dan-shin, group credit life insurance, and without it, most banks simply won't issue the loan. Flat 35, a government-affiliated fixed-rate loan program, is the main exception. Mortgage life insurance is optional there. It remains one of the only paths into a Japanese mortgage that doesn't require this coverage at all. Death or severe disability, the lender pays off the remaining loan balance. If you die or become severely disabled, the insurance company pays off what's left of the mortgage directly to the bank, not to your family, and not as cash they can choose how to use. Here's the part that catches people off guard: separate premium line item on your statement. False. The basic version is simply absorbed into the interest rate the bank already quoted you. The bank negotiates group coverage in bulk with an insurer and folds the cost in, rather than billing it separately the way fire insurance gets billed. Upgrade the coverage, though, and it stops being invisible. Optional riders add real, quotable basis points directly onto your interest rate, visible right there in the loan comparison. A cancer rider, paying off the loan on a qualifying cancer diagnosis, not just death, typically adds 0.1 to 0.2 percentage points to your rate. Go further, to the 3 disease or 8 disease rider, and the markup jumps to about 0.3 percentage points, a meaningfully bigger number on a 30-plus year loan. The 3 diseases in question: cancer, heart attack, stroke. Each one triggers its own payoff if you qualify. For heart attack and stroke specifically, most policies require not just a diagnosis but being unable to work for 60-plus consecutive days, a detail that's easy to miss when you're comparing rate sheets, not policy fine print. Go one tier further, to 8 disease coverage, and 5 more chronic conditions get added: diabetes, hypertension, chronic kidney failure, liver disease, chronic pancreatitis. Those 5 come with an even stricter bar: 12 months or more of continuous inability to work, not the 60 days that applies to heart attack and stroke. The rate premium moves up to 0.3 to 0.4 points to match. None of these percentages sound dramatic in isolation. A few tenths of a point barely registers on a rate sheet next to the headline number. Stretched across a 30-plus year mortgage, though, that's exactly the kind of small number compound interest turns into something real. Concretely, a 35 million yen mortgage over 35 years, comparing the base rate against the same loan with the 3 disease/8 disease rider attached. Base rate, 0.7%. Total repayment over 35 years comes to 39,472,440 yen, about $243,657. With the rider, 1%, total repayment climbs to 41,496,000 yen, about $256,148, for the exact same loan amount and term. 2,023,560 yen, about $12,491, separating the two, spread quietly across 35 years of monthly payments instead of arriving as one visible bill. Nobody signs a form that says 2 million yen, they just accept a slightly higher monthly number. Before adding any rider, it's worth checking what you already own. Existing private cancer or life insurance can overlap significantly with what these riders cover, making the extra rate a duplicate cost rather than genuinely new protection, paying twice for the same outcome. None of this matters, though, if the health check doesn't pass in the first place, and that happens more often than most buyers expect. especially for anyone managing a chronic but well-controlled condition. This isn't a niche problem, either. Enough applicants get declined on standard underwriting each year that an entire secondary market of relaxed criteria products exists specifically to catch them. Every application requires a health declaration, reviewed like any life insurance underwriting decision, not a formality attached to the loan paperwork. Current treatment or a significant medical history can result in an outright decline, independent of your income or credit history. The look-back window insurers typically ask about roughly 3 years of treatment and diagnosis history, not just your condition on the day you apply. Declined on standard terms doesn't mean declined entirely. Wide Dan-shin, relaxed underwriting coverage, exists specifically for applicants who don't clear the normal health bar, using a shorter, simpler questionnaire than standard underwriting. It comes at a cost, typically another 0.2 to 0.3 percentage points added to the rate, on top of whatever the base loan already carries. Most lenders only offer the relaxed underwriting version to a single borrower. It usually can't be combined with joint loans. Worth knowing before assuming you can pair it with a spouse on a joint loan. The cleanest workaround remains flat 35. Skip mortgage life insurance entirely and arrange your own private life insurance separately, underwritten on your own terms, timeline, and price comparison rather than the bank's. Another option for couples, structure the purchase as a pair loan, so the spouse who does qualify carries Dan-shin on their portion of the debt while the other's share gets financed differently, rather than letting one health outcome block the entire purchase. This matters most for anyone comparing mortgage rates without checking what riders are already baked into each quote, anyone with an existing health condition who assumes financing is automatically off the table, and anyone already paying for private life or cancer insurance that might duplicate a rider they're about to add on top. Practical steps: ask explicitly which Dan-shin tier is included in a quoted rate before comparing lenders, check existing private coverage before adding a rider, get the health declaration process started early if a medical history is involved. Compare wide Dan-shin offers across multiple banks since the markup varies, and treat flat 35 as a real option, not a last resort, if standard underwriting looks uncertain. That closes out this series: fire insurance and mortgage life insurance, the two policies almost every homeowner in Japan signs without fully reading, let alone comparing across lenders. Mortgage life insurance is never really optional for most buyers, and its cost is designed to be nearly invisible, right up until you start comparing riders and health tiers line by line. Quick recap: cancer riders add 0.1 to 0.2 points, 3 disease riders add about 0.3 points, 8 disease riders run 0.3 to 0.4 points. Our model case showed a 2,023,560 yen difference over 35 years, and flat 35 remains the main path that skips the requirement entirely. That's what mortgage life insurance actually costs in Japan, hidden inside a number most people only ever see as a percentage on a rate sheet. Subscribe for more data-driven breakdowns of money and investing in Japan.
And that's today's breakdown. If you're serious about real estate or moving to Japan, research like this is exactly what separates a smart decision from an expensive mistake. Subscribe so you don't miss the next deep dive, and drop a comment if there's a city or word you want us to cover next. Thanks for watching, and I'll see you in the next one.